Okay, in this lesson, we're going to talk about income statements, and specifically when you get paid. Every pay period, you're going to receive your paycheck, but you're also going to receive a pay stub. And that pay stub is going to have a lot of information that's going to be vital to you and information that you're going to want to know. So first thing you need to understand about your paycheck is you're going to have your total amount that you're paid, which is your gross pay. Okay, but that's not what you're going to bring home, because they're going to withhold different items from your gross pay. Things that can be withheld from your pay would be Social Security taxes, Medicare taxes. If you have a retirement account that you're contributing to, they might take money out for your retirement account. But the money that you end up bringing home is going to be less than your gross pay. And the amount that you end up bringing home is called your net pay or your take-home pay. Okay, and that all that items are going to be shown on your pay stub or your pay slip. It's just a listing of all your wages and what amounts are being deducted. The deductions for everything that's being withheld as far as taxes go are based on information that employees submit on their Form W-4, their Employees Withholding Allowance Certificate. This is a form that you fill out when you're hired initially that tells your employer how much money you want withheld with regards to taxes. If you hold out too much, then you get a refund every year when you file your taxes. If you don't hold out enough, then you have to pay in to the government at tax time. Federal, state, and local income taxes, those are called withholding taxes, since employers withhold these taxes from your paycheck and they send them to the government directly. Social Security and Medicare payments are also withheld. So at the end of the year, an employer compiles a list of each employee's deductions. That list is sent to you in the form called W-2. A Form W-2, a wage and tax statement, has to be given to employees by the end of January. So if you're working, you're going to receive this statement from your employer by the end of January. It's a breakdown of all the money that you earned for the year and all of the withholdings that your employer has withheld from your pay stub throughout the course of the year, that is withheld from your pay. Okay, so the Form W-2 shows all of those wages that you've earned and your deductions, taxes, retirement accounts, things like that. There's another form that you may receive. It's based on money that you've earned, but not wages. It's called a Form 1099. So if you see like royalties or commissions or something like that, other than wages and salaries, like interest on bank accounts, that's another one. You would get a Form 1099. It's money earned, but money that you didn't receive through your job necessarily, like a wage. All right, so let's talk about some different things that you can see on your pay stub. Barbara started a new job and wants to verify that her net pay, that's her take-home pay, has been computed correctly. Her gross pay was $269.75. So this is what she's making, but that's not what she's bringing home. She has the following deductions. This FICA tax of 6.2%, this is always a flat percentage that's always charged. This percentage is always charged on your gross pay. Also, Medicare tax. Medicare is also a percentage that is always the same, and it's always charged at 1.45% of your gross pay. Then she had federal income withholding. This is a dollar amount, $47.51. State withholding, $16.62. Some states withhold taxes or have a state income tax. Florida does not. So if you're working in Florida, you don't have to worry about this, but other states do. Retirement insurance contribution for $9, disability insurance $2.56, medical insurance $12, and dental insurance for $6. So what should her net pay be? So this is what she's grossing. This is what she's making total, but then she's going to have all these other deductions. So we need to figure out the FICA amount. So $269.75, her gross amount times 0.062, that's this as a decimal, is equal to $16.72. Her Medicare, take this amount times 0.0145 equals $3.91. So this, plus all of these other deductions were withheld. And if you add them all up, you get $114.32. So you take her gross pay, $269.75, minus her deductions, and this is what she is taking home. So you can see that what she's taking home is significantly less than what she actually made because of all the deductions. Okay. So let's see. What percentage of Barbara's gross pay for this pay period accounts for all of her deductions? So percentages, round to the nearest tenth of a percent. Remember, to find the percentage, you take the difference in the two amounts divided by the original amount times 100. So the difference in these two amounts, so 269.75 minus 155.43 divided by the original amount times 100. The difference in the two amounts divided by the original multiplied times 100. Well, the difference in the two amounts is going to be that 114.32. So it's going to be 114.32 divided by 269.75. And then times 100. To the nearest percent would be 42.4%, nearest tenth of a percent. 42.4%. So that's the difference in what her take-home pay. She lost 42% of her income in deductions. She didn't lose it, but it was deducted and contributed to other things such as taxes, and other benefits, dental insurance, and medical insurance, and retirement accounts. So let's look at Lorna's biweekly pay stub, which means she's getting paid 26 times a year, right? Biweekly. 52 weeks in a year divided by 2 is 26. Assuming that Lorna's salary and deductions remain the same throughout the calendar year, how much will be taken out of her total annual gross salary for federal and state taxes? So if you look at her pay stub here, this is for the period 3/15 through 3/28, and this was the amount. This was her gross pay. This is what she's made year to date. That's what YTD means. So up until March 28th, she's made this much for the year, but this is what she made on this paycheck. Her Social Security taxes for this paycheck, her Medicare taxes, her federal taxes, her state taxes, and then any adjustments. See, there's union dues, health insurance, retirement, so there's other amounts that are withheld. She receives 26 paychecks a year. The federal and state deductions are constant. To find the total amount contributed to taxes, multiply the biweekly amounts by 26 and find the sum of those deductions. So her federal deduction, federal taxes, was $1,147. That's for one check. So for the year, you'd multiply it times 26 and get $26,038.22. The state taxes, this was for one check. So for the year, you'd multiply it times 26 and get $7,303.14. So the amount of her deductions just for taxes for the year would be the total of these two, which would give you $33,341.36. That's going to be a lot of money withheld for state taxes and federal taxes. And again, at the end of the year, you're going to file a tax return. And if this number is more than what you owe in taxes, then the IRS will send you a refund. If this amount is less than what you owe in taxes, then you're going to have to send a check for the difference to the IRS. So let's take a look at a situation like that. So employees can choose to increase their tax withholding if they feel that the amount calculated for the tax deductions may not be enough to meet the total tax at the end of the year. From her past records, Lorna knows that her total tax is usually 30% of her annual salary. At the rate of deduction shown on this pay stub, will Lorna's employers have taken out enough? Well, we got to figure out what she's going to make for the year. So we could take this dollar amount and multiply it times 26. So 4596.39 times 26 would give us her annual salary. So 4596.39 times 26. She's going to be making $119,506.14. And she says that her tax liability is usually 30% of what she makes for the year. So if I take this number and multiply it times 0.3, which is 30% as a decimal, I get the number $35,851.84. So this is what she thinks her tax liability is going to be. And the question is has she taken out enough? Well, in our previous problem, we learned that she's going to be withholding around this much, $33,341.36, but her tax obligation is going to be $35,851. So she has not withheld enough. So when she files her taxes, if she keeps these deduction amounts the same, when she files her taxes, she's going to owe, more than likely, she's going to owe money because what she has withheld is less than what she thinks her taxes are going to be. Okay. All right. So this is the W-2 form, and this is the form that you receive at the end of every calendar year that shows your total income. It shows your taxes amounts that you've had withheld. This is your federal income tax withheld. This is your Social Security tax withheld. If you had any state taxes withheld, that's shown right here. Okay. So the question is, in this W-2, let's say Social Security number, on January 30th, Joanne received this W-2 form from her employer. How much did Joanne pay in taxes during the year? So her taxes during the year would be her federal income taxes plus her state taxes plus her local taxes, might be charged by the city. It does not include the Social Security taxes. Okay, so the question is how much did she pay in taxes for this year? She paid the total of these three amounts, and if you add them up, you're going to get $22,287.50. So that's the amount that she's going to end up paying in tax. That's the amount she did pay in taxes last year, because this is an end of year form. So the last question, what percent of Joanne's gross income did she actually take home? Well, remember, it's the difference in what she made and what she brought home divided by the original amount, the gross pay, times 100. So the difference, well, she made $76,350. And she paid $22,287.50 in taxes. So that left her with $54,062.50. Divide that by the original amount, which would be $76,350, and then multiply that times 100. So we're going to take this amount, we're going to divide it by $76,350 times 100 would be 70,000. I'm sorry, we're looking for the percentage. Would be 70.8%. She actually took home 70.8% of what she earned. So this is what she earned, and she took home that amount minus all the taxes, which would be 70.8%. Okay, last example. Amy works for Pound Ridge Financial Planners, and this was her W-2. You can see that her wages and tips, and this was her Social Security wages and her Medicare wages, her Medicare taxes, her Social Security taxes, her federal income taxes, her state income taxes. And then we got this number over here. Okay, we're going to talk about that number there. What accounts for the difference between her wages listed in box 1 and her Social Security and Medicare wages listed in box 3 and 5? So why the difference? There's a difference of $13,200. Okay. Both are earned wages, but they reflect different income amounts used for the calculation of Amy's taxes. The 6.2% Social Security tax and the 1.45% Medicare tax were calculated based on this much of her income. So remember, these amounts are always the same. 6.2% for Social Security and 1.45% for Medicare. They're always the same percentages. Amy made tax-deferred contributions to her retirement plan. So she has a retirement account that she's making contributions to. She's making payments into. The $12,200 that's shown in box box 12A, was deducted from her gross earnings before any federal or state taxes were calculated. So this money is being contributed. She's doing it probably every paycheck, a certain dollar amount, and this is what it totaled. And she's doing it before taxes. So even though she's earning that money, she's not taxed on that money. She's earned it. That money's in here in this amount, but she's not taxed on that money, which is in this amount, because she's making these contributions before taxes. The money's placed in a qualified retirement account. Taxes on this money are deferred until she makes a withdrawal from that retirement account. Okay, the tax-deferred contribution to Amy's retirement fund only accounts for part of the difference. This is $12,200, but the difference was $13,200. So where's the other $1,000? It's this right here. And this is called a cafeteria plan. You see this initial CAF? And a cafeteria plan is basically an account that you can direct money to go into to pay for expenses that you know you will have throughout the course of the year. The most common one is child care or parental care. Okay, so this cafeteria plan, so what Amy is doing is putting money aside before taxes, so she's not taxed on that amount, and she is designating this money for medical bills or child care or parental care or some kind of other medical expense. This money must be used for this. If she doesn't use it for this, this money cannot be, she can't get it. Okay, so if she doesn't use this $1,000, it's a use it or lose it type deal. She's got to use it all or she forfeits it. All right, that's income statements.